Can anyone tell me what is or what do you understand about interest rate swaps, guys? Yes, go ahead.
Yes, like the interest rate swapping, like the floating and fixed. Floating and fixed. They will swap the.
What is floating and fixed?
Floating is variable. The fixed is the interest rate will be fixed whenever the trust. The bonds are getting fixed starting the rate will be fixed. Floating is variable. The price will be like bank loan, personal loan.
Okay. So notional principal amount is, see, we have discussed a number of things about, the nut and bolts about the swaps and all, like principal, notional amount, rate, reset, everything that we have discussed. Without that, you would see like, swap structure or the swap concept is like incomplete in a corporate or while resolving the breaks in your process, right? So you would see all these names. So that's what it becomes very important, means very important. Let's say there are two counterparts. So mute it. Let me explain and then you can unmute. There is a one party which is A and another party is B. Let's say B is GMT fund and A is, let's say, BlackRock fund. And the notional amount is 1 lakh. Okay. When the RBI announced the interest rate, let's say it was 6% for per annum on notional principal amount, and apart from that, so there is a one more rate is exist which is customized, or let's say fixed, which is around 7%. Interest rate which is 6% and customized, or I would say fixed interest payment, which is again 7% on same notional amount. So it means on same principal amount, BlackRock is paying 7% for per annum. On same principal amount, GMT is paying 6% amount. If you see, BlackRock at the moment, they have done some research. See, both are investor. If you see, both are investor. Why they'll do it, what would be the purpose and all, both are investors. So means investment management companies. Investor companies, AMC companies. Right? Both are AMC companies. And if let's say they have done some research and they got to know, means BlackRock got to know, their fund manager got to know, this 7% which they are paying, which is a very high, because The market rate is 6% and they are paying 7%. What if they exchange the interest rate with whom the counterparty is willing to exchange? And let's say GMT fund, they have also done some research, and they got to know, okay, so might be this RBI can, we have an inflation, that is recession, fear of recession, and that's what the RBI can increase the interest rates. And when the RBI increase the interest rate, so this might will affect on their interest liability as well. So it will increase eventually, and they want to protect it, or else the GMT fund want to exchange their floating interest rate with whom? With BlackRock. All this framework will be done via the agreement. Names are very important. International Swaps and Derivative, I think association.
Yeah.
Association.
Yes, association. So they provide the templates. Template, it means it's an agreement, right? Agreement templates. This counterparties needs to update the data, like who is the buyer or who is the other counterparts, the notional amount, reset or settlement period, right, or payment period. So they need to define everything. Then BlackRock's fixed percentage or GMT's fixed percentage, when they can exchange the rates quarterly, monthly, yearly. So that all will be defined on the ISDA agreement. And the ISDA agreement will be carried by any trust or custodian or any prime brokers, because you require someone, middleman, right, or agency. So you would see prime brokers, and that's what, if you remember, Varun, you access the prime broker site to check the swaps details and all, right?
Not currently, yes. Separate teams to move out those reports.
We don't
We don't actually go to the sites.
Okay.
We just basically do the team and they do it.
We access it because in my process, so we directly access the prime brokers, right? So we access the prime brokers, we check the information. Information is like swaps, the payments, means how many payments that we have received, right, for that particular duration quarter, and quarterly, basically quarterly or monthly that we received swap payments, right? So we access directly prime broker site. So prime brokers, they provide facility to the BlackRock as well as to the GMT. So it means prime brokers offer their accounts where they maintain the data, right? Maintain the data, as well as they help you to exchange what? Cash flows. Exchange the cash flows. And how this will, cash flows, it means what exactly, sir? Okay, so here you see 7% on 1 lakh would be around 7,000, and again 6% would be 6,000. So this person will transfer 7,000 to the GMT fund, and GMT fund will transfer the 6,000 to the BlackRock fund. But eventually, the higher the liability, that person will only transfer the amount. So it means BlackRock fund will transfer how much?
10K.
1,000?
Yeah.
Yeah, definitely.
right? So 1,000 difference will transfer to whom? To the GMT fund. So it means in this case, at the ground level or at the performing, any kind of transaction processing or I would say any kind of accounting or matching or reconciliation stuff or settlement if you're doing, then you would see. So here you would see one swap ID. Here you would see one swap ID. Right? So one swap ID against one swap ID and net difference, that we call it as a coupon, swap coupon. So we match this swap coupon. So it means 7,000 minus 6,000, right? So here you would see the difference of 1,000 or minus 1,000. Minus 1,000 plus 1,000 would be your 0. So that's what. So we maintain the data. So we process the trades for this swap ID. We process the trades for this swap ID. So you're going to process this in your internal accounting system, right? Because initially you are not exchanging anything. So once the quarter end or the duration end, like 1 month, 2 months, 3 months, 1 year, whatever it is, then only you're gonna exchange this, right? And when you and the standard procedure is like quarterly we do this. Every quarter we exchange the cash flows, right? So it means every quarter we receive coupon worth of rupees, that whatever the difference should be, right? And that difference we exchange directly. And only that data you would see on a broker statement against the coupon. Against the swaps. 1, 2, 3, maybe 2 swaps, maybe 1 swap, or maybe multiple accounts against which you would see the payment in bank account, right? And from accounting perspective, if you ask me how we perform the accounting and all, if this amount you received, let's say you have received it and you're from the BlackRock side, then in that case there would be two scenarios. One, the difference means coupon is received, and another one is coupon is pending. If it is received, then that comes under the cash based accounting. If it is not, then that would be your accrual based accounting. If it is accrual based accounting, why accrual based? Might be, let's say the particular contract is for annual basis, but they have decided to calculate the interest payment or calculate the cash flows or profit and loss, or I would say revenue and expense. Basically here we call it revenue and expense. And if they are following the accrual base, then you can record the accruals as a swap coupon receivable. So you can check it on broker statement, and that amount you can record it to the balance sheet. So that would be a current asset. At the end of the year, then another counterparts that they will process the payment to. That depends. Means receivable or payable. That depends. Okay. So accordingly, you can record it. But yeah, so that will be the part of your balance sheet. If it is a receivables, you can record it to the balance sheet. If it is a payables, then you can record it again to the liability side of balance sheet. And what if you received cash? Then you received cash, then you can record it to the income statement. Income statement as an that income you have received from the particular swap contracts XYZ with the name of that contracts, you can highlight it. So that's how you accounting work in a fund accounting business or fund business. And if you ask me accounting entries and all, so it is a income. When we say income, so in two ways that we record it. revenue or that income we call income or expense. When we say income, that would be your credit part, right? If you received it cash account debit to income account from swap contract. Expense swap contract account, swap expense account debit to cash and bank. And if it is that accrual base, there's just your income would be again credited or debited, so that you don't need to change it. But yeah, you can add the word like instead cash. You can record entry like payable and receivable then, right? And that's what the balance it come into picture. When we say payable and receivable, then your balance it automatically come into picture. Okay. Any question, guys, so far? Any question? Any doubt? Now you can and ask. And if you see, if it is a quarterly process, then we exchange the cash flows every quarter. Okay, we exchange the cash flows every quarter. Quarter one, let's say difference is 1000. Quarter two, the difference is again 1000. Quarter three, quarter four. So yesterday we discussed one term, right? Fair value through expected future cash flows. You can put a logic here, because in the swap contract you would see the expected fixed cash flows from the contracts. So your swap contracts valuation would be based on the fair value through expected future cash flows. It's kind of bond. In a bond, what we received interest payment, here also we received interest payment. In a bond, we received fixed or floating, interest with the rate of that particular, coupon and all. So here also you would see same. There is no change in it. Correct. And whenever you received your income actual, and that would be the part of your income statement. If it is a pending, then that would be the part of your balance sheet. So you can link with the bond. Means yesterday we discussed terms. If I'm not wrong, only few audience were there, so they are aware about it, right?
Yes.
Yeah.
Value through expected future cash flows. The same you can apply to the any other contract. If you see, if there is a fixed kind of compensation or the compensation which you know it, right? And that's what we call it as like cost of carry. Why cost of carry? Because we know it certain things, and that's what it becomes your cost of carry. To carry, cost means your consideration, guys. Put a logic. What happened? Wait a minute, something happened to my system. Hold for a minute. Okay, I'm audible. Hello.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.